I recently sat in on another syndicator's presentation pitch, and I really liked it. So I'm stealing it and sharing it tonight with you and everyone else listening on the Furlough Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to invest wisely in both property and people through an amazing pitch, convincing you of how awesome this is so that we can do good stuff, which is build wealth and improve housing. I'm James, and this is my wife, Jessie.
I agree that you can beg, borrow, and steal any good teaching items.
Yeah?
Oh, that was like a philosophy when I was teaching, where
Really?
it was just like, dude, you find something good, use it.
Oh, yeah, okay.
I mean, I get
So
that
here's what's...
don't steal in the sense of like, oh, I'm supposed to be paying for this and I'm just going to make copies.
Yeah. Well,
But-
so there's an interesting thing in the art world, or the creative world, we'll say
Yeah,
that,
creative
which
space.
is if you take from one person, it's stealing. But if you take from a bunch of people, it's not.
What? Okay,
Anymore.
give me an example.
Sure. Okay. So like in this case, this guy, he gave a presentation. If I just word for word, like did his pitch, yes, which A, it wouldn't make any sense, but B, well, it would make sense, but it would just be like, yes, I stole his pitch,
Yeah.
but I'm taking his plus my own experience, plus what I've read in other books,
Yeah.
and I'm combining them all together.
Yeah, you're taking
into
pieces
something
of that.
that is new and unique. And
I mean,
so
that's called research.
the goal, which is what's so funny about it, right? Like
As long as you-
yes,
as long
but
as
if
you cite your
only-
sources, I suppose.
But if you only research one person,
Yep.
now we're in the territory of theft.
Sure, I
Which,
understand.
honestly, to boil this up into an even higher level thing, is one of the really interesting arguments around all the AI generations, because they don't just take from one source; they do
Yeah,
combine all the others.
Everything out there.
But now there's all these questions of, well, is it copyrighted? Is it theft? And how does that all work?
Well, especially like the argument that I hear a lot is because it can collect like all the writings of a particular person.
Yeah.
It could write it in that tone.
Yep.
And it's like, oh my word, how do you distinguish? Like AI created the content, but also it didn't. It just referenced a bunch of content.
Yeah.
And put it together in a different way. So it's like,
So also interesting side note,
Interesting.
we're just like, we're headed
Yeah.
down this path, which is cool.
Rabbit hole.
One of the new things for coaches isn't just to offer programs anymore. It's to also offer chatbots that has been trained on all of their content, their
What?
writings, their programs, so that it's not just, you probably don't sign up for this stuff. Well, actually you signed up for one where you know how you sign up for a program and it's like, here's all the videos
Yeah.
and the worksheets
Like
and whatever.
leadership training,
So
yeah.
now the new thing that all of these gurus and trainers, teachers, coaches are doing is they're also saying, and we have a new AI person that I've trained on all of my stuff that you can ask your specific question and it will give my answer
that
back.
sounds super helpful.
So they're doing what you're talking about on purpose,
Right.
and they want it to mimic
Right.
who you are.
But they're not, it's their own thing.
Yeah.
So they're
it's
making
just-
it
it's kind of a
Answer for them.
well, they're embracing that idea of
Yeah.
hey, like here's how I can better serve my students,
Yeah.
clients, whatever.
That makes
It'll
sense
be-
to me. It's just, it's
I'm-
difficult to tell.
It'll be interesting to me to see if like high school or college professors ever do that. Like if I were a teacher these days,
interesting.
I would record every single lesson.
Yeah.
I'm doing every single class. When someone asks a question, I've got that. Like I'm going to record everything and then take that, upload it. And then if you're working on your homework and you have a question, yeah, talk with my little Gen AI guy and he'll help answer the question. Or if you can't remember when something's due or something, whatever, it's all there.
Yeah.
And you're
It's
you're
wild.
training it on your actual teaching. I would 100% do that if I were a teacher. I'd also record everything video-wise and make it all available. But
Yeah.
that's just me. And that has nothing to do with
Anyways.
what we're talking about, which is cool. So, as I said, I'm part of a real estate group in the area, and they had a last-minute cancellation, so they brought in this guy who is giving he's hosting a dinner for high net worth individuals. And at this dinner, he's going to be talking about his latest deal and pitching them and explaining, here's what syndications are, here's how they work.
Yeah.
And he asked if he could practice on our group, given his pitch.
Super
It was
smart.
like kind of a warm audience.
Yep.
Let's go for it. So it was super fun to see it. And he's a guy who I've known for a few years now. Good dude, lives in this area. And he was super successful down in Los Angeles. And
So
now
he's made
moved
these
up here.
pitches before.
I don't think so.
Oh,
so
he's
he's
done
now
other
off
things.
on his own.
Okay.
and he's no longer with the group which was his family. He's no longer with them. He's now doing his own thing, and so now he's having to do. He's rebuilding his network.
Yeah,
essentially.
Be the speaker
and so also kind of interesting is he hired a company that essentially sent out mailers. I'm guessing to a bunch of people, invited them. They're gonna have about 30 people at this dinner.
Oh, wow!
And he pays per lead, and then ultimately pays for dinner. But his whole thing is he's got an active deal, and he's like, yeah, I want to get that fully funded, and so that's what he's doing.
It's almost like, I mean, it's just another way to think through lead generation.
Yeah,
which is another total side topic.
Total side topic.
It's also like super fascinating because it's like, I totally get that. Like instead of having like one-on-one conversations with 30 different people, let's get them all in the same space. Yeah, they all hear the same thing.
Give them all a nice Dalama dinner.
That's right.
And go, which is,
wow.
Right? Super interesting.
Yeah. Interesting.
So
you're stealing his presentation.
Yes.
You like it, so you're going to utilize.
Well, I just thought it was good. And I'm like, hey, the things he talked about were good. And this is me kind of practicing my pitch in terms of some of his stuff. So I'm not going to pretend I'm pitching. We're going to say, and then he talked about this and blah, blah, blah. So the first section that he had was talking about why real estate still wins over other investments, which it was really interesting, the comparison he did. He says it starts out on the surface level. You get the S&P 500, averages about 9%. Real estate averages 6%. And then he threw in, I think it was gold and silver as well, which I think was also in like that 8 to 7% range. And so he was like, on the surface, dude, invest in the stock market. Game over. 9% is better than 6%. And these are long-term averages. Yeah. And honestly, looking at the stock market recently, I'm like, man, I sometimes get jealous that I'm not participating in that. So I get it. However, this comparison ignores some fundamental advantages that are baked into real estate. And so there's 5 levers that most other assets don't have that real estate does.
Okay.
You want to? I bet you can guess what the really big one is.
Location.
No.
I don't know.
These are financial levers.
Equity.
Kind of, but it's related to that. But it's the flip of that. When it's leverage. Which is I'm just gonna chase instead of making you guess. So leverage, right? Your loans. So so his whole thing was, let's say that you have $150,000. You could put that into the S&P and you'll get your 9%. Awesome. Cool. He goes, if you pay cash for real estate, yes, 6% is what you'll get from it for your $150,000. Awesome. He goes, but you're never going to do that.
Right.
Instead, that $150,000 is going to be a 25% down payment. So you're actually going to go buy a $600,000 property. And so your 6% off of $600,000, it suddenly is not just I don't have a calculator, so I can't do the math, and I didn't do it ahead of time. So that's fun. Let's see here. I did do the math. He says that 5 years later it'll have doubled. So your return, your down payment will have. So
you'll
doubled.
have 300,000.
Correct. So it's not a 6% return. It's whatever your annualized 100% is. So 20%, I guess, assuming it's a straight line. It's not, but we'll go with it for now. And so that's your average annual return.
And that's because you can invest in something much bigger.
Correct. Because of leverage.
Because of you.
Yes.
People are willing to loan you the money.
Now, the thing that he admitted in this presentation, which I'll admit too, is this is highly simplified. It is not taking into account there's a whole bunch of other costs related to the property. But he's like, just from the pure value of the asset, at the end of the day, that's what this is. Yeah. Which again, we get into other stuff. Forced depreciation is a huge one. So that 6% was just assuming it goes on with the market. Yeah. Life's good. But that doesn't necessarily have to be the case. You can buy a distressed property, which is what we talked about last week. So listen to that podcast. And then you can force depreciation. Then there you can like significantly increase the value.
That's what I was thinking
rapidly.
when I said equity.
Oh.
I don't know. You're putting something into it.
Got it.
You're like making it better. Sweat equity.
Sweaty equity.
Yeah.
Gotcha. Cool. Yeah. 100%. Yes. Then you are totally right. Yes. Yep. That is definitely one that you
That's
can
a lever
do.
you have control over.
Yeah. The other one which I think is awesome and a really big deal, is cash flow. That you don't necessarily get from the stock market.
Yeah, that's true. You kind of have to wait.
It depends on the deal that you're doing. But yes, usually in a syndication, it's going to take, well, if it's a bigger property, you're always going to have someone renting in the unit, but it's going to be, but you're going to have some sort of cash flow. And once everything's turned, you're really going to have some cash flow.
So if you were just to compare, I realize this is simplifying again, but if you're just to compare like real estate to stock market, are there any stocks at all that you can invest in that give you like that monthly cash flow?
There are. There are actually a bunch of them. They're dividend paying stocks. So what's interesting about them, and there's a couple companies that break the rule, but in general, you get two choices in the stock market. You either get a stock that pays you dividends, some percentage, and it's usually not a lot. It's like that 3 to 5% of whatever the value of the stock. But the stock price tends to stay pretty flat, or it'll go up with inflation. So you're still going to be at that. So inflation, if it's at 3%, the stock will rise about 3%. But then it'll also pay out, say, a 4% dividend. So you 7% return. Cool. Which is totally normal. Or what most companies do is they don't pay out a dividend. And they say, yeah, we're reinvesting it because that's more valuable than us giving the money back to the shareholders. And so the value of the stock rises.
So you get
on average
more,
9%.
but you have to wait.
Or the way that you get the money is to sell the asset.
Yep.
Right. And so there are exceptions. Apple is one of them. They actually are regularly paying out dividends, and their stock price is still skyrocketing.
Which you can do similar things with real estate as well, where if you're doing 100%. Like a flip, you're waiting, but then they get the payout afterwards. It's not like a monthly cash flow thing.
Right.
So.
And that cool part about a syndication is it's a bigger building. And so that's one where you actually, they go together. So as you as you improve the property, rents go up. So your cash flow goes up over time, plus just whatever the market is naturally doing. And then because you're improving the building itself is becoming more valuable. So you get that double bump there.
When you do sell, you also get.
It's because the value of the building is based off of the net operating income. Which we'll talk about later. But how many have we done so far? 1, 2, 3, 4. The fourth one are tax benefits, which you get depreciation. You can do a 1031, which is when you sell your property, you don't pay your capital gains right away. Instead, you roll that into the next one, allowing you to get a bigger snowball that eventually you have to pay, or you die and your heirs, it resets. Whereas anytime you sell a stock, guess what? You got to pay it. You don't get to 1031 it. And you can pass those on to your other investors as well, which is cool. And then there's the natural inflation hedge, which is land is scarce and housing is always in need. Which is not always the case for all stocks.
Yeah, that's true.
So
people need places to live, though. Always.
Yeah. So and his I remember this now. He gave an example of it was gold and crypto, and then a Range Rover. Just as an example, where he was like, because he was looking at it after 5 years, how much would it be worth? And the Range Rover's value, he's like, if you pay $150,000, which apparently you can. I know, right? He goes, that's worth about half as much 5 years from now. He goes, whereas the other ones
don't invest in a Range Rover.
It was cute. Honestly, it was a really fun slide, just to kind of to bring that point home.
Yeah.
And part of it when you're talking high net worth investors, right? That's the kind of decisions they're making. So kind of fun. So that was section 1 of his presentation, just talking about why it's still better and the returns are better overall. And I get it. There's nuance and there's numbers, and this was highly simplified, but he's just teaching the principles behind it. So then he went deeper into forced depreciation itself. So, and we've kind of already talked about this, so I'll go over it real quick. So you have your net operating income, which is your income minus your operating expenses. So it excludes your financing, so any mortgage payments, stuff like that. It's not a part of it. And in commercial buildings, the value of the building is determined by that net operating income. So the more you raise it, the more the value, the more it's worth. Now, the question is, what is that worth? And you have a thing called a cap rate, which is the capitalization rate, which is a way of saying how much do you need to pay to get that cash flow? And so we talked about this a few weeks ago, and it still hurts my head, so we're going to go for it. A low capitalization rate means that you have to pay a lot, you have to pay more for the same amount of cash flow. Or another way to say it is, for the same amount that you're buying, you get less cash flow. It's probably that's directionally correct.
Yeah.
But what's cool about the cap rate is, so you take your net operating income and you you take your net operating income, you divide it by that cap rate, and then that tells you what the value is. Now, he gave some examples where he said in Malibu, it's a 1% to 2% cap rate. It's crazy low. So you pay a lot for not a lot of cash flow. And honestly, you're probably, if you do it just under the standard 25% down and you get a regular loan, you're actually underwater. You're not making any money. A problem, but whatever. And then he gave other examples like Oklahoma, where it's like that's a 10 to 15% cap rate. So for the same amount of money, you get a ton more cash flow, and you actually will be cash flow positive. Now, the cap rate usually it represents risk in the market in whatever you're doing. So in Malibu, there's a ton of demand. There's a lot of people, so there's not a lot of risk. So you don't get rewarded with a high cap rate. Whereas in rural Oklahoma, there's a lot more risk, so you get paid for it. That's kind of the thinking behind it.
Supply and demand affect cap rates?
100%. Yeah. Yep. And Corvallis sits around 5%, so it's pretty healthy, stable with the university, that kind of stuff.
In the middle? Is that kind of in the middle, or is that high?
I would say
it sounds average?
It's middle low. It's middle low. It's normal. It's average for Oregon.
Okay.
And the West Coast tends to be lower than the Midwest in general. I would say like the Midwest hangs out in that 8 to 10, maybe even 15 range.
It's not quite as desirable, so your demand is lower.
Correct. Yeah, that's kind of the way to think about it. So, but what's cool about it is you can, because of that math, you can derive what your building will be. So if you raise rents by $100 a month, that's, let's say just total to make our lives easy. That's $1,200 a year, divide that by the cap rate. You can now say, here's how much value I've added to the property. Super cool.
Yeah.
And that's the whole forced depreciation. So he gave an example of an 8-unit building. He said rents going from $1,150 per unit average, has an NOI in this example was $75,000. That would value it at about $1.5 million at a 5% cap rate. So values at $1.5 million. He says, let's say you spend $100,000 in improvements, you raise the rents from $1,150 up to $1,500 over those 5 years. He goes, the NOI goes from $75,000 to $116,000. And so the exit value jumps from 1.5 to 2.15. He also is assuming that his cap rate has gone up from a 5% to a 5.4 because because again, it's kind of weird when you raise the cap rate when you're trying to value your own building, you're essentially saying, well, I can't sell my property for as much. The cash flow is not as valuable. You're saying there's more risk for the future buyer, kind of way to say it. So you created $640,000 worth of value from doing that operational work, which is awesome.
Yeah.
And so kind of depending on what your down payment was, what you're paying your investors, stuff like that. Sure. It's a good deal. So that's the idea of forced depreciation.
Legitimately are making improvements and raising rents, following the market, yes, but also because you've added value, theoretically.
Yes. Another angle that he looked at was the replacement cost. So if this building burned down and we had to rebuild it, how much would it cost to do it? In Oregon, new construction it's a big range, but it's like it's 375 to 500 square feet. It's $375 to $500 per square foot.
Per square foot.
Sorry.
Okay, I was
yes. Well, yeah. So it's a lot to build.
Yeah.
But if you're buying existing and renovating, that might only be $200 to $232 per square foot when you're all done.
Yeah.
So you're actually buying it at a discount versus a new build. The value's not the same as a new build, so it's not 100%, but it's just a way to think about it. That was talking with some people at Baker Tower when they were like, oh my gosh, well, you can't actually rebuild that building.
Right.
But they were saying if you were to rebuild something of a similar size, they were like, dude, the replacement cost is 10x what I was buying it for.
Yep.
So like, this is a great deal. Like, yeah, I'll take that. So then his next section goes into what a syndication actually is. Okay. Do you remember what the layman's, if you had someone who's like, what's a syndication? What would you say?
There's different people putting money in to buy a property, and then they get a percentage of the returns.
Yeah, that was great. The only thing I would add is that there's a bunch of people to buy a bigger property than normal.
Yeah.
That's but yeah, you were there. So you have two basic people, two groups of people. You have your GP, that's a general partner, sometimes known as a syndicator, sometimes known as the sponsor, sometimes known as the operator.
Yeah.
They go by lots of different names. They're the guys who find the deal, sign the loans, manages everything, assumes all the operational risk.
Make these presentations.
Make these types of presentations, yes. And then you have the limited partners. Those are the people who give you the money. They receive the money back, and their liability is just limited to what it is that they invest in. And the structure is that you create a I don't know, what do you call it? An independent LLC.
Oh.
Yeah, sorry.
For each investment.
Correct. So each property gets its own LLC, and which just protects everybody from all of it. And honestly, it makes it easy because the investors buy shares of the LLC, and it's the LLC that owns the property.
Yeah.
There's nuance here, but as a general rule, that's how that works. You're selling shares to that company. He does go down a regulatory note where you have a 506C and a 506B. So the C is for accredited investors only. So that's the deal that he's doing. It's a C, which is why he's able to give a presentation, because with a C, and you're only going after accredited investors, you can advertise. Yeah, which is what he's doing.
And they have to, accredited means they have to be at a certain level of investment. Is it based on a number?
A certain level of income or net worth.
Oh, okay.
Yeah.
So it doesn't matter how much they put in to the deal,
Correct.
But how much their valued net worth is.
And what's interesting is they recently changed the rules where you can no longer self-certify for that. You have to have like another accountant come in and do the math for you and say, yep, this person's good.
Kind of makes sense.
They changed that rule a couple years ago. And whereas
what's the thinking, like why is it associated with accredited investors and like promotion or advertising? Like I don't understand the correlation between those two things, I guess.
The thinking behind an accredited investor is that they're not going to invest every single penny that they have. They're considered sophisticated investors, which is kind of dumb definition. But the idea being you have enough money, you're probably not going to put everything into this one deal.
So you'll be okay.
Yeah, so you're okay if you lose money. Therefore, we're okay with you finding some person who randomly advertised to you and you're putting your money into that random person's deal.
So they're just trying to protect people's investments?
Yeah. Protect their money, essentially.
That's weird. Why wouldn't they just vet the sponsors as opposed to the investors? You know what I'm saying?
Yeah.
Why wouldn't they say...
That's a great question.
Like, anybody can do presentations, but in order to be a legit sponsor, you got to go through this process. And then investors are like, oh, I know if I invest with this group, it's more stable than I could go with anybody else, but...
So I don't know the official answer, but if I had to guess, it all comes down to what's easier to measure. And it's really easy to measure someone's income and their net worth. Because you just look at their tax statements and you go, or at least their income, like that's an easy answer. And for net worth, again, you can get someone in, you can count it all up and go, yeah, we're good. Whereas with a sponsor, a couple things can happen. Number one, you can have a guy who's good, but the deal itself isn't good.
Oh.
And they're doing multiple deals. So here's the other thing, like potentially, there's some companies where they're doing multiple a year, which means now somebody in the government has to come in and assess not only that person and the deal, and they have to certify, yes, this is a good, safe deal. Or it's a one-time-a-year thing with this other person where they go, yeah, we'll just value your net worth, and if you've hit that threshold, you're good to go. So it's easier to measure, easier to manage.
All right.
And at the end of the day, investments are always risky. Yeah. And I don't think the government wants to be on the hook for saying, oh, we looked into this investment and it's safe.
Yeah. Right. Because then
saying,
if it does go south,
you're still on the hook. Investments are still risky. We're just going to certify that you have enough money where we're okay with you losing some of it.
Huh. Weird.
That's I don't know the official answer. That's what logically makes sense to me.
Yeah.
Which I'm okay with. So that's the 506C. And then you have the 506B, which is the friends and family one. So you can't do any public solicitation. Can't do that. But, and it's now they're like, it's I trust you as a person and what you're sending me. That kind of is how that works. What counts as a friend or family makes for interesting discussions.
Right, because word of mouth can kind of spread. So like a friend of a friend.
So in theory, what I could do is I could put on a dinner that's just a general, we're going to talk about investing in general. I don't have a specific deal.
Yeah, it's like education based.
Maybe I go and I say, I'm going to talk about Baker Tower, and it's a case study. We're going to talk about this and the principles and how you can get involved. I don't have one, but if you would be interested in having one, let's get on the phone and talk, and then I'll put you on my list, and the next one that comes along, I'll let you know about.
So that's
and so
not.
I have moved them from person I don't know to
Person you
someone
do
who
know.
is a friend.
So you can do
who I have
that.
who I have a substantial existing relationship with.
Right,
is the
but you
official.
can't advertise a specific deal.
Now, what's weird, and this is where things get gray area, if I know I've got a deal coming, I still can't give that presentation because I'm doing it kind of knowing
Right.
it. Like,
You're-
now's
yeah,
a
it's
perfect time because I
intended
don't
to
actually
get
have
people-
one in the hopper.
Yep.
I could also do it. So I also, like for our flips, we do a lot of private money lending. Totally different. Could totally do that. There's no restrictions on
Weird.
that one. Like I could totally do a
weird.
presentation and talk about it. It's all about the ownership and selling shares, and the SEC get involved. Like that's the thing. Well, and the other thing about a private money lender, right, is they're in theory they're going to have that deed of trust that's going to be backed by an asset.
Yeah, that's what
They
I
can
was
still
going to say.
lose
They have
everything.
collateral.
It can still be really hard. There's all that.
Sure.
So it's like it's not a
Weird.
guarantee, but like those. So he went into that nuance. He talked about the preferred return, which is the idea of as an owner, sometimes you can do you give a preferred return, which is like you're going to get 8% no matter what, and then potentially the upside is restricted, tamped down, whatever. And all that preferred return says is, yeah, you get paid that no matter what, and you get paid at first. Once you hit that button, once you hit that level, then we're going to split it some amount, 80, 20, 70, 30, whatever.
Yeah.
And, okay. And he then went into the waterfall, which is kind of like the next step of this payout piece. And so here's how the order of money flows. Number one, you're going to pay your closing costs, your broker's fee, your taxes, your whatever. Like all the, I would say the operating expenses all go first.
The operating expenses for a sale or a purchase.
Correct.
Yeah.
I would even argue for operating the building, like paying utilities and stuff like that.
Okay.
I think those all go first.
Yeah, that's still the highest priority.
Yeah, correct.
Okay, that makes sense.
And then what you do is you pay out whatever the accrued preferred return is. And then this one's, I don't know if I agree with this, but that's okay. He says, then you do a return on investor capital, and then you split the remaining 80-20 to whoever, the investors and then the owner. So it's kind of an interesting deal. So, and I know why he wants to do it this way, is your preferred return is based off of your principal that you have into the property. So if you invest $100,000, he owes you $8,000 every single year.
Yeah.
And so what he's doing is he goes, well, I'm going to pay out that first $8,000, but then let's say we actually do $10,000. He goes, I'm not going to actually split that 80-20. I'm going, so I'm trying to make our math a little bit easier here. Let's say that he actually makes $18,000 that first year. So he goes, I pay out that first $8,000, and then he goes, I don't take any money. I pay $10,000, the additional to you guys, but I've now reduced that balance from $100,000 down to $90,000.
Oh, because you've paid some back.
So next year, that preferred return is actually less. It's kind of the
same percentage, but on a smaller
correct.
amount.
And then ideally, it starts to snowball, just like in a regular
yeah.
loan. If he's saying, well, my NOI is going to go up, so therefore my distributions will go up, and I continue to pay it down, eventually I will have paid out that $100,000 minus, or the $100,000 after that preferred return.
Yeah.
He goes, and then we'll just split it all 80-20.
Yeah, essentially he's paying more upfront towards the loan.
Yeah, that's a good way to say it.
And then
And being patient himself.
Yeah,
Because he
waiting.
could, in theory, say, no, we're just going to do 80-20 split, and your balance will stay the same.
sure.
Yay! And then it's just constantly.
Yeah.
And he gets paid some up front, which is nice, but ultimately will cost him more in the end.
Yeah.
The investors make more the other way. So there's
Yeah.
tons of ways to split this cat,
Skin the cat.
skin the cat, to split the split
the
it,
difference?
split the difference, whatever. And so there's lots of ways to do it, and that's part of like you have an operating agreement and a private placement memorandum. Read that; it'll describe how all those flows work. And let's see. Oh yeah, he did say watch for complicated or a lot of tiered waterfalls. Some of them are good, some of them not so good. So like for example, he just goes 80-20 all the way. Some people will add another tier where it's like, okay, we're going to pay 8% per return, and then we're going to do 80-20 until or in this case, I guess you could pay back your capital. Then we're going to do 80-20 until we hit like a 15% return, and then we're actually going to split it 50-50. So I have an incentive to hit it out of the park. And I'll make more if I do really, really well. And he was an investor like, no, I'm still happy because I signed up for that first number and I made way more above and beyond. So you just got to read them. That's a classic, like throw that bad boy in the chat GPT and ask the questions about it. Well, tell me about the waterfall. What's the structure of it? Stuff like that. He talked about refinancing and how the refinance path is a way, and this is what he wants to do with this property, is do all the stuff and then within 5 years, refinance it and return all the capital so that preferred return is gone.
Yep.
And then he's like, and now we just have an 80-20 split for the rest of time or until he decides to sell it. He goes, and you got all your money back, so life's good. And we did ask some questions about if someone wanted out at that time, how would that work? And he's like, it's complicated.
Yeah.
Which I'm like, yeah, it is. So then he went into how to actually vet a sponsor, which I think is really important. And he said most losses don't come from bad markets; they come from bad operators. And so you start with their track record, which I thought was like, honestly, his advice was a little weird. He was like, just ask for the LLC names of the prior deals and look them up and make sure that they're actually there. I was like, I guess that's a good first
That's a start.
step. And I was like, cool. I would be interested in like, well, tell me more about the property. Show me some of the numbers. That kind of stuff. But yeah. And then he said, ask about fees. So, okay, this is interesting. So like I said, there's that whole 80-20 split. That's not 100% true. So there's other fees that the sponsor charges up front that technically come out of the operations side of it. So you have your acquisition fee, which could be 1% to 2% of whatever the purchase price is. Then you can have an asset management fee, which is another 1% to 2% of rents that they charge for it. You could potentially have a construction management fee. So it's going through doing all these fixes and stuff, and that could be 10%, whatever that cost is for them to manage all of it. There's organizational and operational fees. And like, so there's ways that the sponsor is getting paid up front. So he's kind of okay saying, I don't want any distributions until later because I've got other things that come even before those distributions happen.
And how does that,
which are all going to be laid out.
How is it structured with the waterfall? Is it written in there somewhere?
It is in the PPM, but it's not part of the waterfall.
It's not part of the waterfall.
The waterfall is
just
distributions.
Weird. Not fees and
correct. Think of it like a property management fee.
Yeah.
Where it's just kind of
You're managing, putting it to the other
operations, and it's just like it's just tacked on top of that. Huh. That's what that is.
That's good to be aware of.
Yeah. He said there's a co-invest test, which is like, are they putting any money into this deal? Do they have any skin in the game?
Smart.
Yep. And he said the market knowledge test. Do they actually know the market? And so he was like, yeah, there's ways to ask questions to see if they actually know it. That's part of the reason why I only invest in Oregon.
Right.
Because I'm like, I just know it.
Know it here.
I'm here. I know the rules. I'm in it. I feel the market. Yeah. You know, it's like, it's in my soul. As opposed to Texas or Arizona. Yeah, they might be awesome, but I don't know. Like, I'm just not there.
Yeah.
And let's see here. And then, and then he just said, like, when are they paying out, I guess. He was like, just ask about that preferred return again. Those are his ways of vetting the sponsor. That was probably his weakest section, honestly. It was fine. But if I were him giving that presentation, I think I would actually go into a lot more of like, these are deals that I've done in the past. Like, so I've taught you now about forced depreciation and why real estate wins and how syndication actually works and the waterfalls. Let me now go through previous deals that I've done to like, this is actually how this works. And that's the vetting piece. And
there is
for like a dinner, I like
for a dinner that totally makes sense because you're selling yourself, you're pitching yourself.
Yeah.
However, like some of the tools that you've come up with, that's like here's the questions to ask a sponsor. I think that if you're gonna do an unassuming presentation of like, I'm not gonna assume that you want to invest with me.
Yeah. This is just educational, which is what this is.
Right. If you want to invest though, here's the way to approach vetting a sponsor. And
Yeah.
yeah.
Well, it's like we've done that. We did that with our property management stuff where I create a set of questions. Here's what you should ask a property manager. And then you and I recorded an episode where I went through and I answered all of them.
Right.
That would be that's probably how I would set that up. Hey, you should ask about this. Here's my answer, by the way. Here's a good answer.
Yeah.
This one's mine.
Yep.
And just kind of,
And maybe for the dinner thing, you choose your top 5 or something. That's like,
something.
I don't know.
Yeah.
It's an interesting thought process.
It was, which again, he was just warming up on us.
Sure.
He then went into the tax benefits section, which he talked about the K1 documents.
Boring, but I get it.
I know.
People who have more wealth than me. I
again was kind of like, man, I don't know this. I mean, it's a thing. We've all heard about it. There's tax benefits. What are they? And so he went into like, he talked about K1s, which is kind of an interesting, I like it from a setting expectation standpoint. I was kind of like, I don't know if this is a dinner conversation. Like people don't necessarily care about the mechanics of it yet, but maybe. And so he talked about how you can pass on depreciation, income losses, it can offset stuff. He then talked about depreciation and how, just how that works, I guess. And he gave an example of, that $600,000, you might be able to depreciate $40,000 per year, and that passes on to the investors. Yay. He did talk about a cost segregation, but he's choosing not to do it. And which is the idea of, so typically there's a very blunt instrument where you say, well, what percentage of it is land? What percentage of it is building? And then you can write off the building. And the bigger ones, it's 39 years, 39 and a half, 39 years. But what you can do is you go, well, like there's a bunch of appliances in here. Those aren't 39 years. Those are 5 years. And so you go through and you do that for appliances, carpet, anything and everything.
Yeah.
And you have someone official go through and calculate it all out, and they do all the math to say this property was worth 600,000. Turns out 10,000 of it is appliances, and 20,000 of it is carpeting, and some percentage of it is the roof, and then the land and the building, and like they go through because each of those have different amounts, and then so they then break that out. It's not just one number divided by 39, we're good to go. Now it's, well, we have like 6 categories, and we're gonna divide all those by their different numbers. So it allows you to front load a lot of depreciation early on. It costs money to do the cost seg, and the biggest objection that I've had to it is a bunch of the cost seg people have they've optimized what they charge.
Yeah.
Because they can be like, hey, if you do this, we can accelerate on average $200,000 worth of depreciation, and we're only going to charge you $150,000 or whatever, right? Like I've just made up those numbers, but it's like, but those are the where you're like, so it's definitely a lot of money up front. And I was going to get that depreciation no matter what. I just get it today rather than tomorrow. Now for his deals, he wants to be out in 5 years. I'm like, yeah, you know what? That actually makes a ton of sense to do it for that kind of project. So I was kind of surprised that he chose not to. Where for like Baker Tower, I want to hold on that one for a long time. So I'm like, I'm eventually going to get it all anyways. It's not worth it. And I have a bunch of retirement accounts that don't get to participate in it anyways. So I'm like, this isn't just not worth the squeeze. But talked about that. He then talked about the 1031 exchange, which I thought was really interesting that he brought that up. And the way that he presented it was like, you can do a 1031. It's like, not like really, because you don't buy the property, you buy shares in a company. And the only way you can do a 1031 is if the company then sells that property and buys another one.
Right.
Which means all the investors got to come along for the ride. Yeah. Now, there's ways to get around it. You can do a tenant in common, and it's a thing that you can do for like if you have major investors, people who put in a significant amount of capital. You can say, hey, you are going to own the property along with the syndication, and you become like a non-voting whatever member of this purchase. And now you own some percentage of the property, which is what you're going to own anyways as a limited partner. And then you can go 1031. It's like, but it's a lot of... It's a lot more paperwork and a lot more complicated to do it that way. So it's like, so I only want to do it for the big investors.
Sure.
Like, yeah. But so I was surprised that he talked about that. I guess, I don't know. He's trying to get ahead of particular objections. He didn't talk about opportunity zones, which was whatever. And then he goes, this is not tax advice. Go talk to your CPA. So I was like, that was good. He then went into talking about Corvallis, and he threw up a couple graphs, which I thought were interesting. Like, Corvallis is stable in the sense that when the recession hit, it didn't dip down as much as some places. But when things boomed, it didn't boom as much either. It was just more,
more
down the
even.
middle. Which, when you're talking about investors and preserving capital, like, yeah, we don't get the boom, but we also don't get the bust.
Yeah.
So it's just going to be a lot more steady even. So I thought that was a good,
That is
good argument. He then talked about vacancy and how Corvallis has very low vacancy and it's just stable in general. And he went into things like the urban growth boundary, Oregon State. He said we have a diverse economy. Which I was like, is that true? I guess that's true. And then he was just like, and there's quality of life. This place is awesome. I was like, yeah, I think I agree with that. And so that was his presentation. Oh, I guess he closed saying real estate syndications aren't magical. They're just really good if they're handled well. And the mechanics of how they work are learnable, and the vetting process isn't terribly hard. They just skip it. And so, that was his presentation.
Right.
That's what he went through.
See, I don't think he would steal that presentation like word for word.
I didn't.
There was definitely lots of things in there that you'd be like, okay, yeah, I might include that or I might do that. But
yeah, he had one slide which I thought was really good. I took a picture of it. I was like, ooh, I like the way it was presented was nice. And that's the other thing. That's one of the cool things about this is like, hey, if you want my slides, just ask. Like, I'll send them to you. I'm like, that's cool, whatever.
Yeah.
And
you're going to have to adjust them to whatever your deal is anyways for it to make sense. And
yeah.
general
100%.
education, sure.
And I have a
makes
different
sense,
design aesthetic too. So,
Yeah.
what you going to do? Going to change the logo out. No, the dinner thing was interesting. I was intrigued by that. But that was what I heard. It was good. So hopefully that was educational.
Yeah.
And you're like, oh, cool. That is a good overview of what needs to happen. And that is what you should do before writing a check to
Or
somebody.
maybe you're like, man, I wish I was eating dinner right now.
Dang, right?
While I heard that presentation.
But I'll tell you what. Hey, here's the deal. Here's the deal I'll make with you. Anybody, if you want to invest with me on my next deal, I'll take you out to dinner.
Hey,
that's cool. We could talk about a deal. I have investors. We hang out regularly. It's awesome. I get if you're out of the area, it is what it is. But, man, if you're local, totally. Now, if you don't invest, no dinner. No, I'm kidding. I'm totally happy to meet and talk about this. And if you do want to learn more about us in general, the best place to start is to go to furlough.com, where you can learn more all about what we're doing. And we'd love to connect and talk about what your investment goals are and how we can help best get you there. So with that, thanks for listening. Have a great day.